I'm Susan Myers. I'm a strategic advisor with Goal 17 Partners, which is a relatively new not-for-profit organization whose mission is to drive sustainability, equality, and accessibility through private-private collaboration toward SDG achievement. We actually grew out of a convening platform first initiated by Guggenheim partners at the 2016 World Economic Forum annual meeting. And the platform now includes a range of other partners, both from the private sector, but also philanthropy, academia, and the UN. Goal 17 Partners has in many ways been powered by the firm Handshake, led by Kerr, who you will hear from at the end of this session. But I really want to acknowledge the entire team at Handshake who is providing the platform on which these virtual sessions are possible. Virtual sessions are just as hard to organize as in-person sessions. So thank you to that team for everything they've done to make this series possible. Because strategic convening has always been part of our model at Goal 17 Partners, it was really a natural transition for us to pivot these convenings into the virtual space, just like we've done with our other activities, including a series of design labs for the private sector, which you'll hear a bit more from JR at the end of the session. But for the series we're hosting this week, which kicked off on Tuesday with a really interesting discussion on urban mobility in the context of COVID-19, you can already see a summary and video of this session on the Goal 17 Partners website if you missed it. And this series will culminate with a really exciting fireside chat at 2:00 p.m. Eastern today between Mike Milken and Scott Meinert of Guggenheim Partners. And we've been really pleased to host this series in collaboration with the Milken Institute, including through a role that MacLean will be playing in leading us through today's discussion. Caitlin serves as Senior Director for Innovative Finance at the Milken Institute, and we conceived the topic of today's discussion. We really thought she would be the perfect person to lead us through the topic. So thank you very much to Caitlin, and the floor is yours to take it from here.
Excellent. Thank you, Susan. Thank you, JR. Thank you, everyone. Good morning. We're very excited for the panel today. As Susan mentioned, I oversee innovative finance at the Milken Institute. For those of you who don't know us, we're a financial and economic think tank. And what we look at is how you create market-based solutions to big social and economic challenges. And obviously right now we are in the midst of both a social and economic challenge. And so we're excited today to hear from this group of panelists who represent different types of capital and different types of organizations across the spectrum of what we would call sustainable investing. And obviously that can mean different things to different people. That can mean purely commercial rate investing. It can mean looking at ESG factors. It can mean impact investing, all the way down the spectrum to more blended finance and more philanthropic capital. So very excited about the panel today. I'm going to skip formal introductions and introduce people as I go to them with questions, just because we're limited on time. So I want to make sure we save enough for the conversation. So just to give a bit more scene setting, I think what we see at the Institute, obviously right now in this pandemic, is potentially with a silver lining an opportunity to look at some of these financing and funding models and look at where there have been kind of historical gaps in some of the funding and financing, and try to be better and come out of this better and smarter and more effective and efficient in how we are looking at using capital to address social issues. So with that, Jim, why don't I start with you? So on probably the more commercial end of the spectrum, Jim Pass, who is the Senior Managing Director at Guggenheim Partners. Jim, from a commercial perspective and looking at the markets, obviously there's a lot of uncertainty right now, which is understandable. But where have you seen interesting kind of opportunities or kind of challenges in terms of how you all have been thinking about sustainable investing and how you're able to actually act on that in this time during the pandemic?
I'm sure, Caitlin, and thank you to JR and the whole team at Goal 17 and Handshake for putting this together. I've been pleasantly surprised that the conversation during the COVID situation has really remained focused on sustainability and ESG factors. In many cases, there was an opportunity or a thought that it may actually get deferred. But in the infrastructure side, as well as on the the pure investment side, companies and developers and countries are still very focused. And I think the biggest change, there's been more attention driven to healthcare, which is a natural conclusion, and how that will impact the ESGs, and how do we design an asset class that can help achieve the SDGs by the end of the decade. But going to your question in particular, I think a lot of conversations have been had on price discovery, looking at assets or looking at opportunities that can survive and have done well in this environment, as well as opportunities where there's been some stress, but at the same time, there's definitely a need. And so it's been, I would say inconsistent, but there are opportunities, and they really phase. Mobility is definitely a key area, whether it's how you define it is definitely changing. But I think when you're looking at, innovative financing solutions, all stakeholders are now at the forefront. Every investment we do is going to be impactful, and it really is trying to solve a problem. And ultimately, I think the priorities and how we look at an investment doesn't change, but now we just have different factors to consider. And in this environment, healthcare and how do you plan for pandemics are near the forefront.
Would you say, curious if you've had conversations internally or with clients, obviously initially when sustainable investing was really kind of growing in interest and demand, there was still a bit of a pushback around what the role of fiduciary duty is, right? So what does that really mean? And I'm curious if you've seen more of a shift now that people are going through something where they see the effects of a resilient community and a resilient infrastructure, which we may or may not have enough of. And I'm curious if you've had conversations with folks internally or externally about willingness to look more at an expanded role of what a fiduciary really means.
Well, I think initially everybody looked at you had to survive. You had to make sure that your the company or your project you invested in was going to remain viable. It was going to survive the economic shutdown that we all experienced. And once we got comfortable with cash burn and more of a technical term, it really became much more of a position it in the right place. How do you survive 2020 and make sure that you're positioned to handle whatever may be thrown at you in 2021. And during those conversations, sustainability and trying to understand, expected returns and how, the current situation was impacting your investment became to the forefront. And I think, up until now, green bonds, or really the E that's part of ESG, was really the focus. And so now I think the focus is now there's a wider audience that we're actually looking at the S factor. What is the social aspect of an investment? How do you social distance, or how do you deal with the healthcare component? And so to answer your question, those conversations have occurred. They are continuing to occur, and really trying to make sure that the financial return is stressed and can handle various scenarios. But now we also have an assessment tool that we really have to focus on ESG, and we call that at Guggenheim the sustainable quotient, where we look at social capital, human capital, and really green capital. And then the government component really would be that transparent capital, making sure that the policymakers, we can understand their thought process, we understand the ramifications. And that's probably been where the biggest emphasis has been lately, trying to time and understand the economic reopening when you're looking at an asset class that, is global. And ultimately, infrastructure or just investing in general, putting capital to work is very, very critical to the economy. And, this is just a stepping stone that, to be honest, we've been very pleased that the conversation, through these virtual meetings has continued. And so we're hopeful that, throughout the summer and the rest of 2020, the conversation will continue.
That's great. And certainly I think more and more people are understanding the governance, both at a project, at a company, and for us at a federal level as well. So I want to go, because Jim mentioned, the E and the S, certainly go over to Michael Kashani, who is the global head of ESG portfolio management and fixed income for Goldman Sachs Asset Management. Michael, obviously, you've been looking at all of the factors for a long time, but I would imagine you've seen some interesting things come out of the reaction to this pandemic from clients. So talk a little bit about some of the maybe surprising things that you've seen as a response to this pandemic.
Great. And again, thank you for having me, and hope everyone listening is healthy and safe. I think what's been really interesting here is that people have realized that ESG integration is fundamental. I think it's always been, should we consider these factors? Should we consider these themes? Should we look in this data? It's been pretty clear that they should be. And I'd say what's not changed, but what's been enhanced is the engagement with management teams. We go into a level where I'm mostly dealing with the public markets, where we've seen massive supply. We do have the ability to pick and choose between issuances in portfolio for strategies and issuances that impact, I would say, the broad market. And our ability to engage with management on these themes, hold them accountable, which I think is really important. A lot of people in the fixed income market have said, well, engagement, that's for equity. We can't vote our shares. What can we do? We can do a lot. Especially as a broad participant, our engagement happens every time a bond issuance comes to market. And if they're looking for favorable terms, I think that there's a real opportunity to change the conversation of ESG with just the chief sustainability officer, compared to the CFO should be able to answer those questions as well. And in one area, if we're thinking about, Jim was mentioning, green and social bonds, which are fantastic, and the use of proceeds on bonds should be focused on those issues, but we want to see bonds that focus on what are you going to do with your capital. And so we've seen that on the environmental side. There have been sustainability-linked loans, and then the first sustainability-linked bond. We want to see social-linked bonds. If you're making a commitment to your employees, if you're making a commitment to the general public, then show it to us with some step-up feature coupon. I'm going to get very boring with some bond lingo right now. A step-up feature coupon if you don't meet that. It's really proving that these organizations want to be accountable and are not doing the right thing, doing the thing that's best for their employees and the general public in order to create better stakeholder value.
You might argue that doing the right thing and doing what's good for the company should be the same. Curious then, and Jim brought up the heavy kind of incidence of E versus S traditionally, and you were mentioning that as well. I'm curious what your thoughts are about a demand for better metrics to actually articulate what that S should be, so that if you are structuring a fixed income instrument based on the impact, do you find that people might be now more savvy in terms of what they need to be asking for the S?
Yeah, I think they are, and I think that's because we've moved to, I think I've said this before, I hope that everyone with ESG in their title goes away. My wife doesn't like when I say that, but I think for this to become truly mainstream, it's about the fundamental analyst that's covered a utility for 20 years asking these questions. It's every portfolio manager asking questions. I do think that there's a role for us in the dedicated ESG sustainability space to move the ball forward, make sure there are better constructs like worker safety. In the US, we've not been receiving worker safety data like we did 4 years ago. And we've seen the impact of that because a lot of these ESG factors could have been overlooked because performance, profitability was high, but now we've seen those entities that were not performing well, they really don't have the flexibility here when the issues when we're in this unfortunate situation right now.
You highlighted an interesting point, I think, that leads really nicely to our next speaker, to Courtney Leimkuhler. So Courtney, Michael was mentioning worker safety. Certainly during this pandemic, we've seen a highlight on safety, on our human capital for companies, for communities, for projects. And I'm curious, obviously for you as co-founder at Springbank Collective, what you all look at in terms of the infrastructure to ensure, especially more gender equity in the workplace. There's obviously going to be a renewed interest right now. And I would say, want to make sure that that continues and we don't kind of slide back into the kind of status quo. So what would you say in terms of how the kind of impact capital that you're seeing is looking at investment opportunities right now through this pandemic? And how do you then use that to not just have a relief response, but a long-term kind of preparedness response for, you know, future kind of how we work and any future risks we come up with?
Oh, sorry, lost you. Thanks, and thanks for having me. Yeah, look, I love what Michael is saying, and Jim as well, focusing on the S. I think I feel optimistic to the point that you've raised. I think there's a lot of good momentum that can be built upon in terms of the way that companies and large employers in particular have reacted to the crisis and stepped up the S, right, and have started to provide infrastructure for their employees. You know, there's a lot of great data out there. You know, we know sort of the top 100 employers have gone 70% to work from home. You know, 40% of them have added paid sick leave. You know, almost a quarter of them have added backup care for employees. So that there's a lot of important infrastructure there that's been provided in the breach in the time of crisis. And I think there's good momentum. It's going to be hard to stuff the genie back in the bottle on those things. So I think that's an important catalyst in this. And I think, you know, from a public company perspective, comps are blown out of the water, right? Year over year earnings, guidance has been pulled. And so I'm a former CFO. I mean, now's the time. Throw in the kitchen sink, take the charges, take the restructuring, do the right thing, which for management teams often is hard, right? When you're living in sort of a year over year comps world. Now's the time, I think, to step up benefits and step up commitment to sort of other ESG factors, because you know, going forward, there's sort of a new normal. And I think from our perspective in particular, you know, at Springbank, we are very focused on gender parity and trying to catalyze the construction of infrastructure that supports women and working families. And, you know, part of what needs to be done is to recognize that these are not niche issues, right? And I like what Michael says, you know, ESG needs to go away. The term women's issues needs to go away too, right? Care is now obviously everyone's, you know, universal sort of human issue. These are not niche challenges that apply to women with small children. You know, 75% of employers identify as caregivers. And so I think there is a lot of momentum from the actions that we've seen for companies to, you know, continue to provide this infrastructure. I think that the challenges and where innovative capital becomes really important is kind of getting ready for the catch. So if corporations are willing to step up and if governments are going to release more funding to kind of support this infrastructure, we're sort of woefully under innovated and under invested in care infrastructure in particular, and all services really that support women and working families, because it has been viewed as this niche, you know. And some of my favorite stats, right? We've put from an early stage capital industry perspective, you know, sort of venture investing, we put $50 billion into food delivery startups, and we've put $30 billion into gaming. We've put $3 billion into care for kids. I mean, that's the same amount we put into food delivery in the last 12 months. So, you know, we have this amazing innovation apparatus in the form of startups and venture community globally. A lot of it obviously concentrated in the Valley. But in my perspective, we're solving the wrong problem. And so a big part of what we need to do to capture the good momentum is to get the innovation apparatus sort of ready for the catch and increase the funding that is going into innovation in terms of the real problems. Gender is one that I care a lot about. We have lots of important problems to be solved and a huge amount of capital to be unlocked if we can bring this more mainstream, right, and direct some of the most smartest and some of the most risk taking, the largest risk appetite capital we have, and point it at some of the most essential problems. And then obviously policy needs to fill in the gaps, right? We're not going to innovate our way out of this for our most vulnerable workers. If the largest employers offer paid leave and flexible working, that's not going to support waitresses and the gig economy folks. And there are going to be many, many more of those vulnerable gig type workers, right, in a soft economy. And so I think we need to sort of obviously think about what is the policy implication and how do we pair policy and innovation. I had a call yesterday with a company that's using data to try to create a new insurance product for parental leave. And that's a nice pair up. There's a lot of talk about federal paid leave. We need it. That's what's crazy. The US doesn't have it, but we also need innovation, right, to help companies, again, be ready for the catch and kind of swallow the pain of that if we don't want to have a big drag on the economy.
So one of the things that you mentioned there in terms of the comps and allowing companies to perhaps free up some of their limited resources, right, to be more innovative. Given that there are liquidity constraints kind of generally across the board, do you find that this is a moment where you think that companies will actually start to try to innovate, or will, the general sense might be, they're going to be so cash strapped that they're going to be less inclined to, try to be new, try to be, cutting edge. And maybe that's an opportunity for more impact driven VC kind of folks like yourself to help kind of bridge some of that gap. Where do you think you'll see that trend in terms of investment in innovation, given the challenges right now in the markets?
So I think you're right. Obviously, companies are going to have to pull back. What we need big companies to do is we need them to be the customers for a lot of these services. We don't need them to invest in services, right? Organic investment for public companies is really hard, right? It's hard to make the public markets wait while you get payback on organic investment. That's okay. I think there's a tremendous amount of company formation and innovation that can still happen in the startup world. I think that's where there's still a lot of dry powder in private equity and in venture. We've raised enormous funds over the past few years. Much of it is not yet deployed. So I'm optimistic that we can turn that apparatus and we can start really backing innovation in these critical areas of infrastructure. And then we need the big employers to be the customers. And to me, being a customer is less of a capital intensive commitment. And I really like, Michael's idea. I mean, to the extent it becomes capital intensive, or if, we're talking about huge companies with millions of employees, let them finance it. Let them go and raise, a sort of bond linked, right, to social outcomes and employee investment. And I would be interested to see, if there's demand there for that. I don't even think that's necessary, though. I really think that there's always a moment for restructuring. There's a reexamination of the cost base. I don't think we're talking about huge numbers. I think what we're talking about is the fact that it's been hard to transition infrastructure, to take write-offs, to break leases, to go to more flexible work, to add benefits. But I think in this environment where a lot of business is going to have to be rethought and restructured, I feel optimistic that there will be opportunity to free up capital to become customer, right, to add a little bit of operating cost to support employees.
That's great. And I think that speaks to the need for innovation and the risk taking. I think leads us nicely to Matthieu Pegon, who is the head of blended finance for IDB Invest at the Inter-American Development Bank. Matthieu, obviously, looking at kind of the role of bi and multilateral agencies, there is sometimes, and certainly in the role that you fill, an ability to absorb some additional risk when you're talking about potentially concessional financing. And so, at the same time, you're looking at Latin America, I think just this week surpassed the US and Europe in daily coronavirus cases, new cases. how are you seeing the role of blended finance and the IDB in the region in terms of immediate response, immediate relief, right, in terms of helping to strengthen some of the social services that are needed right now? But then also looking forward, is there an increased role that's needed from some of these agencies because they can accept more risk to help to try to drive some of that innovation that's needed?
Thanks, Kathleen, and thanks for Goal17 for having us. It's a very good question. Look, the outlook is pretty grim for Latin America and the Caribbean. As you said, the region is still battling with an health crisis that is still pretty much going on, and that is getting bleaker. And if you look at some of the economic projections for the region right now, the last number I have is minus 5% GDP. Which is unprecedented for the region, and that's echoed in all the indicators. I mean, just look at the outflows for emerging bond markets in the region, and you're going to see pretty much the same picture. So for us, there's a bit of, okay, what do we do faced with that situation? There's a lot of demand right now for liquidity in the market. So, for example, our trade facilitation program, we've had an increase in our demand of 200% for that product, which is allowing financial institutions in the region pretty much to import goods. So that's also give you a good indication of the need for liquidity in the region. So we've increased our target for the year from 5 billion to 7 billion with a focus on responding to the crisis, and also with a focus on providing liquidity to the market through that trade program, but also helping financial institutions, utilities to deal with the crisis. As a side note, we've issued 1 billion bond a couple of weeks ago. And when you think about multilateral agencies, and when you think also about private sector investment in the region, let's not forget that we're owned by government, but our debt is private. So our institutions are themselves a tool of de-risking. I mean, we issue quasi AAA paper, but then if you look at the individual risk we take in the transaction, it's much lower than that. Now the question is, how do we go forward, and how do we deal with the tension that you were referring to between this need for short-term liquidity, but then sort of long-term sustainability goal, especially considering that when you look at the root cause of the crisis, it's very difficult not to think about climate change, loss of biodiversity, and how this contributes to a risk of more pandemics going forwards or more adverse events going forwards. Whether it's an hurricane or a pandemic, we should brace for more of that in the future. And there is a tension there. One way we've been looking at that, and that sort of echoes what Mike was saying as well, is okay, we're going to be giving liquidity to financial institutions. We're going to be giving liquidity to electric utilities so that they can continue service the customer without being paid. But what are we going to get in exchange for that? And one product we've been pioneering, and I'm also going to go in the bond jargon, is zero coupon structures, where we're essentially giving liquidity up front to those financial institutions, those utilities. We're not going to ask them for any payment in interest in principle for a couple of years, but then we're going to ask them to comply with a couple of milestones during that period. That will also include the recovery period. And at maturity of the transaction, if they meet those milestones, they're going to be benefiting from a preferential rate and the ability to refinance. And if they don't meet those milestones, well, they'll pay us a market plus a premium. Now, when you look at those milestones, and that's also echoing what Mike was saying, traditionally, a lot of what's been done in the past is really looking at use of proceeds. So, I'm issuing a green bond for 300 million. I want you to invest those 300 million in green assets. I think here we need to go a step forward. And that's also how we're structuring those milestones. So you keep those sort of use of proceeds milestone, but you also ask for the company to change. So you're going to ask them, for instance, for financial institution, you're going to ask them, okay, you need to put a climate change and sustainability consideration at the core of your business model. And there are tools for doing that. And we're going to include in those milestones, not only those use of proceeds milestones, but we're also going to ask you to disclose for climate risk in your financials. And we're also going to ask you to commit for decarbonization metrics going forward. And it's really how you change the system. Last but not least, I think the crisis also challenges the role of multilateral agencies in a region, especially in sort of more established markets like Latin America and the Caribbean. And I think going forward, it's really about shifting from a mentality which was traditionally a originate and hold mentality to really an originate and distribute mentality where we take the construction risk of a solar farm, but then once that plant is operating, we make sure that plant is being refinanced in debt capital markets, and that's recycling our capital, and that's also crowding in private capital in the region, and that's where we're really playing our role of de-risking. Thanks, Caitlin.
That's great. No, and I think it ties nicely back to what Michael was saying in terms of putting him out of a job or changing his job, right? No longer having ESG functions, and that you're looking at the issuer and not the use of proceeds, right? So if you're telling them that they have to bake into this, the metrics and the capital planning and disclosures, that's very exciting. And goes nicely to our final speaker, David McCauley, who is the Senior VP of Global Partnerships and Multilateral Engagement at the World Wildlife Fund, the WWF, whose background is not fake. That is a real background. It's not virtual. And Dave, I'm curious, are you hearing a lot about the shift in focus from an E to an S or a G, but sustainability, as Matthieu just mentioned, is linked. All of those are linked, right? So the ability for us to respond to pandemics, especially as we see the effects of climate change, where we might have more and more of these pandemics, as well as natural disasters alongside pandemics, right? So coming into California wildfire season and possibly also having coronavirus. Obviously, there's a lot there that's linked. So I'm curious how, as a nonprofit, you're looking at some of these partnerships in a capital constrained environment to be able to still meet, kind of the services and needs for the communities to make sure that we are prepared, but looking at kind of alternative partnerships that you might need to get through kind of that funding gap you might have.
Sure. Well, and let me begin by saying thanks to the organizers. It's great to be with you. It is no question. There's no question. It's a global crisis, and you'd expect all forms of investment to be affected, and from the philanthropic and social investing through to commercial. What we're seeing is obviously the early signs of a shift in priorities, particularly on the public sector side, in terms of the attention to health issues, and that's natural. But also a huge increase in government funding. So when we're talking about blended financing, where we were talking billions before, we're talking trillions now, literally. And so there's a huge emphasis on how to pay attention to environment, social governance considerations in the social safety net and the interactions between those, as well as looking ahead to recovery packages and stimulus and job creation in sectors that also further the climate or environment agendas or social agendas. So it's an exciting time from that standpoint. I think it's an opportunity to make new partners for an organization like WWF to work more with the health sector. There's a big, as Matthias mentioned, the connections between zoonotic disease risks and the degradation of environment and the markets for illegal markets for wildlife. That's one aspect. And then the collapse of the wildlife tourism sector in Africa or around the world, really, and the tourism sector more generally, nature-based tourism, both on the social safety net side to try to keep these places, keep these employees in place, and also the guards, the sort of oversight of natural resources to, we're already seeing huge poaching increases, for example. So, and then transitioning from job protection to job creation through employment in investments around natural resources management. So all of that, I think, is a new set of considerations that we have, and it's terrible that we're having to live through this, but also we have to look for those opportunities that it creates to move forward at much greater scale and much more quickly.
That's great. So I know that we're coming up at time, and I want to again encourage folks who are listening and to actively participate and put a few more questions in the Q&A. But while you're doing that, maybe a lightning round for all of the panelists about one thing they see that they're optimistic about for 2021 in terms of moving towards more of that kind of long-term recovery and hopefully preparedness for future events, whether that's industry related, whether that's financial product, whether that's, kind of looking at kind of innovation broadly. And Jim, maybe I'll start with you, and maybe if I could lead you somewhere, just because we've been talking about the liquidity constraints, and certainly at a government level, that's significant at a state and local, from a state and local perspective. Talking to the folks from Governor Newsom's office, the governor of California, saying that, at the beginning of 2020, they were projecting a $6 billion surplus, and they're now projecting a $54 billion deficit. Obviously, that impacts what happens in terms of infrastructure, as one example. And Guggenheim was a very strong proponent of post-2008, the structure of Build America bonds, other types of kind of innovation in terms of what the public sector can do to help encourage private investment. So can you talk a little bit about maybe something that would like to see in 2021, or you're excited about kind of moving forward, how we kind of exit out of this kind of post-COVID?
Sure. I think the biggest, where we're most excited, is that there's a tremendous amount of work where standards and really measuring tools that can measure sustainability of infrastructure assets. We're talking about projects. We're not talking about companies. We're talking about how sustainable, an airport terminal may be. How do we design it better with value engineering, taking into consideration, environmental concerns, social concerns, and so forth. And this movement has been much further along in Europe and Asia, but now there's projects in the United States that are very, willing to be assessed by an independent third party that will, go even further than some of our EPA designs or EPA measurements. And when you have something that is a metric that is uniform, institutional investors can actually analyze and design portfolios around those risks. And so with the standards being developed and working with organizations such as the WWF, Guggenheim is working with Tufts, as well as some other entities, we're actually analyzing up and running projects in light of these standards. And what I hope will happen is that these standards will still be a volunteer aspect, but we'll bring that to the state and local governments. So when they're designing, a new hospital wing or a school or a wastewater facility, they'll take into consideration not just the lowest cost, but also the impact on the environment, social aspects. And I think that will really attract much more private capital, whether it's an equity or a debt position, because now we can actually support and justify not just the financial return, but also discuss a sustainability return that I mentioned earlier.
Great. Excellent. So quickly, try to be maybe 30 seconds. Courtney, I'll go over to you.
Two things. I think we're finally seeing some sort of federal momentum on things like paid leave, which I hope will be enhanced in 2021. And we're seeing an uptick in what's called a Kerr RFP. So the same way that companies put out an RFP for a 401k provider or health insurance, they're now recognizing that there are care benefits that they need to offer, and they are putting out RFPs and using consultants and brokers. And I'm optimistic that we are seeding the sort of new care economy.
Great. Michael.
I like that we're seeing leadership. We're seeing the head of the IMF talking about climate transition, a just transition, inclusive growth. And when we look at potential restructurings like Ecuador, and thinking about that as part of the recovery process, I do think, not in every situation, I do think we're trying to build back better, both from the environmental side as well as the social side. So that's something that we want to not only be supportive of, but we believe brings better long-term value for our clients.
Great. Dave? I think you're still on mute. One more time.
Yeah.
There you go.
In addition to the UN Secretary General and Kristalina Georgieva at IMF, I'm optimistic because the big institutional investors have not abandoned this newfound interest and really push for sustainability. So I think the demand from that side is going to remain strong. We were a little bit worried about it, but that's the thing that really most encourages me. Of course, it's through the lens now of the COVID crisis, but it has not waned. If anything, I think there's been sort of a wake-up call of the human connection with nature as a result of this, and I see it as a very positive push.
Excellent. Matthieu, looking at 2021.
The level of awareness. I lived the previous financial crisis in the middle of the trading floors, and it's fair to say that nobody really cared about sustainability consideration. That has changed, and I'm really hopeful that that level of awareness also translates into something that is more concrete when we look at recovery.
Great. So we have a few questions, and I try to kind of synthesize some of those into maybe just kind of one big question. And maybe, Courtney, if I can channel this your way. So in terms of looking at, kind of impact investing, as we've talked about innovation, and there's a role for some of the big corporations, there's role for multilateral agencies, institutional investors, but perhaps the most agile might be for some of those kind of early stage investors to look at a portfolio of startups that have solutions that could be then absorbed by some of those bigger players. So just curious if where you would see kind of some of the sectors that would be most primed for that type of investment right now.
I think certainly future of work is obviously a sector that's been starting to get some traction until now. And I think that, people are sort of referring to it as the kind of e-commerce moment, right? So flexible work, telehealth, obviously is another one that I think has sort of bumped along and now may have turned the corner from behavioral change. I think behavioral change in general is the silver lining to all this when it comes to ESG, like everyone has been commenting on, whether it's, in the kind of debt markets or whether it's in venture or in corporate, we've brought forward probably several years worth of slow behavioral change and slow awareness change. It's accelerated. And so I think that's really where the opportunity is that drives adoption. And then that's what really gets the flywheel going and is attractive from a private early stage venture approach, right? Is to start to really see behavior change and adoption behind innovation. It's easy to come up with ideas. It's hard to kind of get them to pass the early adopter threshold and cross over to mass market. So I think those are areas I have talked a lot about. Care, I think that's another area which is going to see a lot of innovation, is already seeing innovation and has potential. And then, of course, I think there is a renewed focus on climate and on technology related to whether it's carbon capture and sort of other innovation, which has been basically underfunded, I think, by the traditional venture world. I think definitely there'll be a renewed focus there.
I know we're at time, so just before I hand it over to JR from Goal 17, just want to thank all of the panelists. An excellent conversation, very excited about kind of greasing that flywheel, right? As Courtney just mentioned, all of these ideas to try to bridge some of the current funding gaps and obviously the long-term funding gaps to achieve sustainable development. So thank you all for the panelists. JR, thank you for the opportunity. Over to you.
Thank you, Caitlin, and thanks again to all the panelists. It's good to see some old friends on the panel, as well as some new friends like Courtney and Matthieu. So thank you very much. As Susan mentioned at the beginning of this panel, Goal 17 is an organization committed to bringing private to private sector solutions to sustainability, equality, and accessibility. This is a session that's part of a series that we've done in collaboration with Milken. Just a few closing comments on sort of what Goal 17 is up to, and for those that are interested, how you might be able to engage. A couple of things that we've done. So first, we are using our website as well as some working calls to highlight the ways that the private sector are essentially addressing this COVID crisis, but doing so in a way that builds out the muscles and the capabilities to live and act differently on the other side. So go to our website, you can see a host of content there, as well as you'll see upcoming virtual activations. And then finally, we've actually developed something called virtual design labs. So it's occurred to us, both in our thinking as well as from some of the feedback we've gotten from our partners, that this is a time to start thinking deeply about some of the things mentioned on this call, that maybe now is a good chance for private sector companies to go deep, both with each other as well as internally on fair pay, to think about financial mechanisms to, in fact, achieve some of these ESG goals. And so these design labs will launch this summer. They'll be for small groups of companies. Think of it as an executive education for a company on equality, accessibility, sustainability, these sorts of things. So be on the lookout for those. So once again, thank you very much to Caitlin, to our panelists, and to our partners. We look forward to many more of these, and again, to building back better together. So have a great day, and thanks so much. Cheers.